The financial industry has convinced millions of us that a 1% management fee is a tiny, reasonable price to pay for professional advice. It sounds like almost nothing, right? But here is the illusion: that 1% isn't taken from your profits. It is extracted from your entire portfolio balance, year after year, whether the market is hitting all-time highs or crashing. Let's look at the actual math. A 1% fee doesn't cost 1%. Because you lose that money, you also lose the decades of compound interest that money would have generated. Over a 30-year investing horizon, that 1% fee can devour up to 25% of your total potential wealth. You take 100% of the risk, provide 100% of the capital, and they walk away with a quarter of your life's work. To justify this massive wealth transfer, advisors rely on the complexity trap. They take your money and slice it into 15 or 20 different mutual funds. It looks incredibly sophisticated on paper, making you feel like you could never manage it yourself. But it's smoke and mirrors to justify their fee. If you're ready to break out of this trap and manage your own wealth, hit subscribe right now. And the bleeding doesn't stop at the advisor fee. Those 15 complex mutual funds they put you in, they carry their own hidden expense ratios. You are paying fees on top of fees for actively managed funds that, statistically, end up trailing the simple S&P 500 or total market index over the long run. I decided to stop looking at the high-level dashboard and dug into the actual PDF statements. Here are the receipts. Over a 3-year period, my so-called personalized advice fee drained $4,544.46 directly out of my account. That is over $4,000 that should have been buying more shares and compounding for my retirement. Seeing that number was the breaking point. If you are tired of Wall Street skimming your wealth to pay for their glass high-rises, it is time to take control. I fired my advisor and replaced them with a ruthless, highly efficient system built on real academic data. But be warned, Wall Street doesn't let go easily. Months after I took back control of my accounts, a ghost fee of $152.61 hit my balance. Because they bill in arrears, meaning they charge you for the previous quarter, you have to watch your accounts closely even after you leave. The complexity of 15 mutual funds is gone. I replaced the advisor with a streamlined, automated 4-fund portfolio. Instead of lengthy quarterly meetings, I spend exactly 15 minutes a month managing my wealth. No emotion, no stress, just a mechanical system designed to build wealth. The foundation of this system is zero-fee market capture. I use Fidelity's FZROX to capture the entire US market and FZILX to capture the total international market. These are mutual funds with a literal 0.00% expense ratio. I get total global diversification without paying a single cent in management fees. But just matching the market wasn't enough. I wanted an edge. That is where the rocket fuel comes in. I use a strategy called a factor tilt, specifically targeting small cap value. I use Avantis funds, AVUV for the US and AVDV for international, to overweight my portfolio in the specific types of stocks historically proven to drive higher returns. Because I am a late starter to serious wealth building, my asset allocation needs to be aggressive but calculated. Here is my exact $1.55 million breakdown: 31% in the total US market, 36% in total international. Then, I apply the heavy tilt, 16% in US small cap value and 17% in international small cap value. Why lean so heavily into AVUV and AVDV? Because that is where the most reliable risk premiums live. We are stepping away from the massive tech giants that already dominate the total market funds and putting our money to work in the engine room of the global economy. Does this actually work in the real world? Here is the proof. Looking at my early 2026 year-to-date returns, this specific 4-fund allocation is sitting at a 7.88% return, significantly outpacing the broader S&P 500 during the same period. The factor tilt is doing exactly what it was designed to do. Strategy means nothing without execution. Here is my bonus check strategy. When new capital hits my account, like this $3,996 deposit, it doesn't sit in cash. I immediately deploy it, funneling it directly into my 4 targets based on my target percentages. Every dollar is assigned a job. This is my payday routine. As soon as a Roth contribution or paycheck transfer settles, the gears start turning. I evaluate which of the 4 funds is currently under target, and I route the new money there. It forces me to buy low and keeps the portfolio perfectly balanced over time. The true secret to this system is removing human emotion. I don't try to time the market. I don't care what the financial news is predicting. I log in, I buy my targets, I log out, and I go outside and touch grass. The system only works if you let it run. If you are currently with an advisor, you need to do the detective work. Do not trust the clean, simple interface on your brokerage app. You have to download the actual PDF statements and look for the line items labeled transaction costs or advisory fees. That is where they hide the damage. And don't ignore your workplace accounts. Many 401k are traps filled with high-fee target date funds. Look into your plan documents to see if you qualify for an in-service distribution. This allows you to roll funds out of a restrictive 401k and into your own IRA, where you control the fees and the fund choices. This for-fund approach isn't Wall Street gambling or stock picking. It is rooted in decades of peer-reviewed academic math, specifically the FAMA French factor models. We are targeting specific characteristics of stocks that have compensated investors with higher returns for over a century. The first is the size premium. A massive company like Apple or Microsoft has a very hard time doubling its footprint, but smaller, agile companies have massive runways for growth. By holding small caps, we are capturing that explosive growth potential before they become mega corporations. The second is the value premium. This is essentially buying $1 for 80 cents. We are targeting companies with strong fundamentals, solid cash flow, and real profits, but that are currently being ignored by the hype of the broader market. We buy value, we hold, and we let the fundamentals win. Taking control of your own portfolio is the highest hourly rate you will ever earn. Next week, I am launching my Factor 4 Feet series, starting with a massive deep dive into AVDV and why international small cap value is critical for the next decade. Hit the like button, subscribe to the channel, and let's build real wealth together.